Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3, variant 32, Feb March 2024, question 2.
The question states that KPLC's financial year ends on 31st December. An inexperienced bookkeeper had prepared a draft statement of cash flow for the year ended 31st December 2023 by only comparing the balances of each item in the statement of financial position for the year ended 2022 and 2023. The draft statement of cash flow for the year ended 31st December 2023 is as follows. Increase in the non-current assets at cost was taken as negative $33,000. Increase in the provision for depreciation was taken as $22,800. Decrease in inventory was taken as $2,000. Increase in trade receivables was taken as negative $7,000. Decrease in trade payables was negative $1,500. Increase in accrued loan interest was $600. Increase in ordinary shares was $20,000. Increase in share premium $5,000. Increase in retained earnings $9,600. Increase in 8% loan $10,000. Net increase in cash and cash equivalent was $28,500. Cash and cash equivalent at the start of the year was $38,900. Cash and cash equivalent at the end of the year was $67,400.
Furthermore, the following balances were also available on 1st January 2023. The non-current asset at cost was $325,000. Provision for depreciation was $195,000. Ordinary shares were $180,000. Share premium was $6,000. Retained earnings was $25,100. 8% loan interest was $20,000. Accrued loan interest was $800. Furthermore, we have a new item of office equipment was purchased to replace the equipment which was purchased in 2021. The equipment disposed of had a carrying value of $9,000 at the date of disposal and was sold for $6,200. It is the company policy to depreciate office equipment at 20% per annum using the straight line method. A full year's depreciation is charged in the year of purchase but none in the year of disposal. Next, loan interest of 1,600 was paid. Dividends of 22,000 were paid. In the A bit of the question, we are asked to explain one reason why the information in the statement of cash flow of a business is important to its shareholders. There may be various reasons why the information in the statement of cash flow will be important to the shareholders. One of them is it provides the information about the availability of cash in the business. You see, it helps them to know that whether the business have enough cash to conduct the operation so that the business can generate profit to provide returns to the shareholders. Another reason may be because it helps to determine the liquidity and solvency of the business. You see, many successful business or profitable business have failed because of insolvency. That is, they may not have sufficient liquid assets available to pay the long-term and short-term liabilities. So, cash flow statement provides the information about whether there is enough cash to fulfill the liabilities, and if there is no sufficient cash, then the business may go bankrupt, which may result in the shareholders losing their investment. In the B bit of the question, we are asked to calculate the profit for the year for 2023. We'll start with our working notes. You see, we'll start with the statement of change in equity. And in the statement of change in equity, what we do is we take the opening retained earning. To this, we add the profit for the year. From there, we subtract the dividends which are paid. And if there are any transfer to reserves, like transfer to general reserves, we subtract that. And then we get the closing retained earning. So now what we need is profit for the year. So we'll take this opening retained earning to the other side. That is, we subtract from the closing retained earning, we subtract the opening retained earning. And here dividends are subtracted. So if we take it to the other side, it will be added. And we don't have any transfer to reserves. So now our profit for the year will be equal to retained earning carried down, that is the closing retained earning. From there we subtract the retained earning which has been brought down, that is the opening retained earning, and then we add the dividends which are paid. The information for the closing retained earning was given as it was increased by $9,600. So what we have to do is we have to take the opening retained earning which was given as $25,100 plus $9,600, which will show that there is an increase of retained earning by $9,600, and then from there we subtract the opening retained earning of $25,100, or we can directly take the difference, that is the difference between the opening and closing retained earning, which will be $9,600. Then we add the dividends which have been paid, which was given as $22,000 in the additional information. So 9,600 plus $22,000, we will get the profit for the year as $31,600.
In the C bit of the question, we are asked to prepare the statement of cash flow for the year ended 31st December 2023 in accordance with IAS 7. Now, before proceeding and making the statement of cash flow, let's do all our workings in our working notes. We'll start with the profit from operation. You see, profit from operation is the operating profit which we calculate in the statement of profit or loss. So, in statement of profit or loss, what we do is we calculate the operating profit. From there we subtract the interest and the tax, and then we get the profit for the year. We know the profit for the year as we have calculated in the bit B of the question. So now what we are going to do is we'll get the operating profit by transposing interest and tax to the other side of the equation. And here we don't have tax, so we'll just transpose the interest to the other side. So now for us the profit from operation will be equal to the profit for the year plus the interest for the year. Now let's calculate the interest for the year. You see, the information given for the interest is for the year ended 31st December 2023, increase in accrued loan interest was $600. That means when compared to the opening accrued loan interest, the closing accrued loan interest was more by $600. So the balance on 1st January 2023, the accrued loan interest was given as $800. So now our closing accrued loan interest will be 600 plus 800, which will be $1,400. Furthermore, it was also given that the loan interest of 1,600 was paid. You see, when we make the statement of profit or loss, what we do is the interest which belongs to the period, that is here between 1st January 2023 to 31st December 2023, whatever interest belongs to this period, whether we have paid it or whether it's outstanding or accrued, if it belongs to this period, it has to be subtracted in the statement of profit or loss. So here if we see the information which is given, that is on 31st December 2023, we have already calculated the accrued interest which was $1,400, and this belongs to the current year, that is the year for which we are going to make the profit or loss statement. So this have to be added to the total amount of interest, and then it will be subtracted in the statement of profit or loss. And then here furthermore what is given is the balance on 1st January 2023. This is the previous year balance which have been brought forward to the present year, and there was an accrued, that is a outstanding loan interest of $800. This do not belong to our current year, so based on our timeline, this amount have to be subtracted from the amount which is paid, and the amount which belongs to the current year have to be added to the interest which we have paid. So the loan interest which was paid was $1,600. To this we add this $1,400 and we subtract this $800. So the interest for the year which we subtract in the statement of profit or loss will be $2,200. Now as we want to find the operating profit, it is the profit before interest and tax, hence we are going to add this back to the profit for the year, that is which we got it in the bit B of the question, so that we get the profit before interest and tax, which will be the profit from operation. So it will be equal to 31,600 plus 2,200, which will be $33,800. Next we have a new item of office equipment was purchased to replace the equipment which was purchased in 2021. The equipment disposed of had a carrying value of $9,000 at the date of disposal and was sold for $6,200. It is the company policy to depreciate the office equipment at 20% per annum using straight line method. A year's depreciation is charged in the year of purchase, but none is charged in the year of disposal.
So here it was given that the equipment was purchased in the year of 2021 and this was sold or replaced in the year for which we are making the cash flow statement, that is year 2023. And here it was given that the depreciation is 20% per annum using straight line method. So the depreciation for the year 2021 will be 20%, for the year 2022 will be 20%. However, there will be no depreciation charge in the year 2023 as none is charged in the year of disposal. So the total amount of depreciation which is charged on this equipment was 40%. And here the carrying value, that is the net book value, which is cost minus the accumulated depreciation, is given as $9,000. That means if 100% is cost, then we have already deducted 40% as depreciation and the value which we have here 9,000 is 60%. We don't know the cost, so we will find the cost, that is if 60% is $9,000, 100% how much? So when we cross multiply this, it will be 9,000 times 100% divided by 60%, which will be $15,000. So now we know this is the cost of equipment which was sold. So now on this the depreciation which was charged was 40%, that is 15,000 times 40%, or from 15,000 if we subtract 9,000 we get the value as 6,000. This was the provision for depreciation which was charged on the office equipment.
You see, we have calculated the provision for depreciation for disposal so that we can calculate the depreciation which was charged for this year, and this was charged when we have calculated the operating profit. And as depreciation do not lead to inflow or outflow of cash, what we have to do is we have to add the depreciation which was charged in the statement of profit or loss back to the operating profit when we do the operating activities for the statement of cash flow. So we'll calculate the depreciation for the year by making the provision for depreciation account. You see, provisions, liabilities and capital will have the opening balance on the credit side. So the opening balance, that is the balance on 1st January 2023, which was given in additional information, will be mentioned on the credit side as balance brought down $195,000. Out of this amount was subtracted because this equipment have been disposed. So when we want to subtract something from the credit side, we write it on the debit side as disposal $6,000. Furthermore, it was given in the information that is there was an increase in the provision of depreciation by $22,800. So the opening balance, which is $195,000 plus $22,800, will be $217,800, which will be the closing balance of the provision for depreciation. Now when we total this side, debit side, that is, we'll get the total of $223,800. From this, if we subtract $195,000, the balancing figure will be the depreciation charge for the year, and that will be $28,800, and this will be added in the operating activities. Furthermore, we will find out the purchases of office equipment during the year. For this, what we are going to do is we are going to take the increase in non-current asset which was given as $33,000. Furthermore, we have sold a equipment. Even after selling the equipment, this has been the increase in the non-current asset. So we are going to add the amount of or the cost of office equipment which was sold, which we have calculated as $15,000. So the total amount of office equipment which was replaced or purchased during the year will be $48,000. Now let's make the statement of cash flow for the year ended 31st December 2023. We'll start with the operating activities, in which we take the profit from operation, which we have calculated in the first working notes as $33,800. Next, loss on disposal of office equipment. You see, in our second working notes we have seen the carrying value of the office equipment was $9,000 and we sold it for $6,200. That means the loss, which is the carrying value minus the selling value, was $2,800, and this loss indicates that we have under depreciated our office equipment. So when we calculate the operating profit in the statement of profit or loss, we subtract this as an expense. However, this do not lead to any inflow or outflow of cash. Hence, we are going to add it back in our operating activities. Furthermore, when we have calculated the depreciation in the second working notes, I have mentioned again that depreciation do not lead to any inflow or outflow of cash. Hence, we are going to add this back as well. That is $28,800 will be added. Next, we have decrease in inventory, which means that we were able to sell more goods, and because of this there was decrease in inventory which led to a cash inflow, and the value was $2,000. Hence this will be added. Increase in trade receivable, that means more of the goods have been sold on credit, and for this we have paid all the expenses to manufacture these goods, and which led to outflow of cash. So increase in trade receivable of 7,000 will be subtracted. Decrease in trade payable, that means we have paid the trade payable, because of which it have been decreased, and this will lead to cash outflow. Hence we are going to subtract $1,500. So when we add and subtract all this, we get cash from operation as $58,900. From here we subtract the interest paid. Only the part which have been paid will be an outflow of cash. Hence we are going to subtract this, that is $1,600. Then we will get net cash from operating activities as $57,300. Next we have investing activities, in which the purchase of office equipment, which was calculated in the third working notes, which was $48,000, and this leads to cash outflow. Hence we are going to subtract it. Then the sales proceed of office equipment, the value which was given was $6,200, and this leads to cash inflow. Hence we are going to add it. So from 48,000, which is negative, we add 6,200, we will get negative $41,800 as net cash used in investing activities. Then in financing activities, it was mentioned the ordinary share capital was increased by 25,000. So this means there have been new issue of ordinary shares of 25,000, which leads to inflow of cash. Hence we are going to add this. Then we have received a 8% loan, which again was mentioned as an increase in the 8% loan, and as this leads to inflow of cash, this will be added as $10,000. Then the dividend which have been paid, which was given in the additional information, will lead to outflow of cash. Hence we subtract it. Thus we get the net cash from financing activities as $13,000. So now we take this, that is $57,300 minus $41,800 plus $13,000. We will get the increase in the cash and cash equivalent as $28,500, and the cash and cash equivalent at the start of the year was $38,900. So when we total this up, we get the cash and cash equivalent at the end of the year as $67,400. In the debit of the question, we are asked to analyze the change in the cash position of KPLC during the year 2023. So what we will do is we will write the activities which led to cash inflows, and then we will write about the activities which led to cash outflows, so that we can mention how the cash position of KPLC have changed. So we will start with KPLC have generated a positive net cash flow from operation. That is, when we have calculated the net cash flow from operation, we got the value as $57,300, and as this is an inflow, this suggests that the operating activities have been maintained more profitably. Then the another reason why there was an inflow of cash was because KPLC was able to increase their finances by means of issuing of new shares of $25,000. Furthermore, they have also increased in 8% loan by $10,000. However, this will also lead to an outflow of interest by $800 because this leads to increase in financial charges. Although there was net increase in our cash from operation, as well as there was further increase in the cash flow by means of loan and issue of shares, this was the reason why KPLC was able to pay the dividend as well as the interest, and it was also able to buy the new office equipment. Thus, there is net increase in cash and cash equivalent at the end of the year of $67,400. Thus, this shows that KPLC have a good liquidity position in the year 2023. So with this, we have completed this question.
Thanks for watching my videos. Have a great and peaceful life.